This is the Alhambra Investments Weekly Market Pulse with CEO Joe Calhoun. And Joe, anybody who's invested for a while understands that things that happen outside the U.S. can have an impact on their portfolio, even if they own all U.S. companies. But there are also some things that will take place based on a country's individual currency. Investigate that for me, will you?
Well, yeah, what I wanted to get across here this week is that markets outside the United States, you can look at them in two different ways. You can look at them in local currency terms, or you can look at them in dollar terms. And most Americans look at things in dollar terms. If we look at, for instance, EWG, which is the Germany ETF that trades here in the US, it trades in dollars. And so when we want to say what's going on in Germany, we look at EWG and we see it's down 17% or whatever it is. Well, that's fine, but it may not give us a true picture of how things are in Germany, because these international events, in this case, what happens in Ukraine with Russia has an impact on natural gas to Germany, has an impact on energy costs. There were all these wild rumors about, oh my gosh, German industry is going to have to shut down and all these things. Of course, those things haven't happened, but they have an impact not just on stock markets and bond markets, but they have an impact on the currency market. So a lot of people in the US, for instance, or in other places, they don't want to invest in Europe because they're worried about this Ukraine-Russia thing. Okay, so the fact that they take money out of Germany or out of Europe and put it in US dollars, that means drives the dollar up relative to the euro. And so when we look at the German market from our perspective, it looks like the German market has done terribly. It's actually underperformed the United States, the S&P 500. But when we look at the German DAX, which is their version of the Dow, it's only actually down 8% and change. And that's because the euro has gone down as well. So a US-based investor has lost money, not just because the DAX has gone down 8%, but also because the currency, the euro, has gone down another 8.5% or whatever the number is. So I think it's important, though, if you think about that, hey, if the stock market in Germany is only down 8.5% or so, maybe what's going on in Russia and Ukraine is not as dire as people here think. So I just think it's a different way of looking at things. Now, the currency matters is the point. And I think that you want to get a true picture of how things are economically in Germany. You got to look at things in local currency terms, and it paints a much different picture. So I just think you want to look at things from a variety of perspectives, and it helps give you a fuller understanding of what's going on in the world.
Well, you talked about Germany here, but in your written report, I mean, you listed several international markets that, when compared to their own currency, really have done pretty well this year.
Yeah, I mean, look, there are countries, actually, by the way, every currency in the world is not down against the dollar this year. Everybody seems to have that impression, but it's not true. And actually, two currencies in our own hemisphere that have gone up against the dollar this year, the Mexican peso and the Brazilian real. Both of those currencies are up against the dollar this year. It's interesting. People have this idea that, oh, the dollar's really strong. It must mean emerging markets are having terrible problems. Well, yeah, but maybe some emerging markets, maybe China, maybe whatever, but not necessarily. It's you can't paint with a broad brush. Again, another reason why you want to look at the details sometimes and say, hey, emerging markets is not just some giant monolithic thing where they all act the same. So if we look at the Mexican market and the Brazilian market, they're both up on the year. And even bigger, the Chilean market, if you look in terms of Chilean peso, the Chilean market's up 22% this year. So, and you can get the same effect in Europe. France has outperformed the U.S. this year, S&P 500 measured in euros. Spain is only down like 4% measured in euros. So again, this idea that all of Europe has this giant problem, yeah, maybe not. I don't think Spain is all that affected by what goes on in Ukraine and Russia, to tell you the truth. And maybe their market reflects that. So, yeah, I think you want to look at a variety of perspectives. It gives you a different view of the world.
Well, last week we talked about a short-term downtrend in the dollar, and the dollar keeps moving back and forth a little bit. So what happens if we return to that long-term uptrend in the dollar?
Well, the long-term uptrend is still intact. Okay, it's the short term that's turned down, and I would say too that what we really look, we're not we're intermediate term investors. That's kind of where we focus. We can't be too short term because that's a trading environment where you're trading things less than a year. That's not really our bailiwick. It's not what our clients want. Our clients are long-term investors. That intermediate space is more where we're focused, which is multi-year, but we're not talking 10, 15 years. The long-term trend, the really long-term trend started around 2011 when the dollar started to rise. We were down in the 80s then. No, actually in the 70s. I think the dollar index was actually in the 70s when this rally started. We went all the way to 114 and change here recently. Now we backed off. We're about 105 and a half today, somewhere around there. So it's the short-term trend that has changed. We don't really make a lot of changes with our portfolio based on really short-term trends. So this is a short-term trend. If, on the other hand, we break that intermediate uptrend, which would happen if we break under about 102 to 103, somewhere in that range. If we break that, then the intermediate term trend has changed. We would expect the dollar index to probably trade into the low 90s if you can break under that level. And then we probably would make some changes to our portfolio to take advantage or take greater advantage of this idea of the dollar falling. When the dollar falls, you want to own international investments because you're going to make money on the currency as well as making money on the inflows of capital to these other countries that tends to have a positive impact on their stock markets. So it's kind of a double effect there. Just as, by the way, we've had kind of the opposite over the last 10 years, where U.S.-based investors, by staying in the U.S., actually, made a lot more money than they would have if they had diversified and invested outside the U.S. because they lost money on the currency as the dollar went up. So, like I said, we haven't broken the long-term trend. That would require really a break under about 92, which is way down there and would take a long time to get there. And a lot can happen over a year, 2 years, something like that, which is kind of the more of that intermediate term that I talked about.
So if you had any advice for the average investor with all of this, would you say to them, don't be so laser focused on what you're looking at for your portfolio, but have a broader idea of what's out there?
Well, yeah, I think that's it. But I think really the main message here is don't fall victim or fall prey to home country bias. All investors are guilty of this. I've seen portfolios. People come to me, an Australian comes to me and asks me about his portfolio. Look at his portfolio. It's majority Australian stocks. Why? It's familiar. And it's in his own currency. And that's important to some degree. You're going to be, if you're getting ready to retire, you're not going to be spending euros. You're not going to be spending Australian dollars. You're going to be spending US dollars. And so you naturally gravitate towards these US dollar investments. But there are times when international investments are going to be a great boon for your portfolio. We've seen this. We saw this in the 70s when the dollar was weak. We saw this in that period of 2002 to 2008, where the EFA performance was roughly double that of the S&P 500. So there are times when you want to be outside the U.S. And I think it's important to look around the world and look at these markets and look at individual markets in terms of different currencies so you get an idea of how things are going. It gives you a fuller picture of the global economy.